Hello, everybody, and welcome to another special edition of a PowerPoint presentation. This is all to do with finance. It is about the capital investment decision making. So, making decisions of managing investments and capitals in finance. So, before I go into all the finance decision making and investments, I'm going to present my title beginning. Capital investment decisions. Now, let's start this presentation up on capital investment decisions. Decisions on capital projects. Organizations should make capital investment decisions in line with their mission statement and strategic objectives. Organizations may have many more potential investment projects that they can invest in. Capital budgeting should be used as a decision-making tool. So those are the main decisions of capital projects. Let's move on to the next slide. Okay, capital budgeting. CIMA, official terminology, defines capital budgeting as the process concerned with decision making in respect of the choice of specific investment projects and the total amount of capital expenditure to commit. Capital investment decisions are generally long-term decisions and should be based on profit, not on contribution. So that's what capital budgeting and capital investment decisions are. Okay, let's move on to the next slide. Cash flow and accounting profits. If a new piece of equipment is purchased, there will be an initial cash outflow. The new equipment may result in savings, so there will be cash inflows over the life of the equipment. There may be costs incurred on the equipment over its life, like, for example, maintenance and disposal costs, which will be cash outflows. Net present value, profitability index, internal rate of return, and payback periods all use cash flows in their calculations. Those are what cash flow and accounting profits work when it comes to investment decision making. So let's move on to the next slide. This is more on the cash flows and accounting profits. Depreciation is not included in investment appraisals that can use cash flows as it's not a cash item. Accounting rate of return uses accounting profit in its calculation. Okay, now the next slide. The time value of money. Net present value, probability index, and internal rate of return take into account the time value of money. €1 today is not worth €1 in 1 year's time if money is invested in return for interest. Compounding, €1 is worth €1.05 in 1 year's time if it is invested at least 5%. Discounting, if we want to earn €1.05 in 1 year's time, we must invest €1 today if the interest rate is 5%. Next slide. That is going to be about choosing a discounted rate. To use NPV or IRR, a company must choose a rate of return for discounting future cash flows back to their present value. It may choose the opportunity cost of the investment It depends on the company's attitude to risk. Usually organizations use their cost of capital as their discount rate. It may also be referred to as the minimum rate of return. Those are decisions of making discount rates. Okay, now on to the next slide. The net present value. The net present value is the sum of the projected cash flow of a project discounted at an appropriate discount rate. If the net present value is positive, the project should be accepted. If the net present value is negative, the project should be rejected, and then choose the project with the higher NPV. Net present value. Okay, now let's go on to the next slide. The benefits of net present value. Net present value takes into account the time value of money. It also considers all future cash flows, provides an absolute result rather than a percentage like IRR. Next slide. The drawbacks of net present value. Can be difficult to calculate as it requires an understanding of discounting, which can be difficult for non-accountants to understand. It also requires the company to have decided upon an appropriate discount rate. That's the drawbacks of the net present value. Let's go on to the next slide. The internal rate of return. The internal rate of return is the annual expected return of the investment over its life. It is the discounted factor of which the net present value of the investment is zero. It can be ascertained in a number of ways, such as the linear interpolation methods. Let's go on to the next slide. The benefits of internal rate of return. Uses the time value of money in its calculations. The decision using internal rate of return is easy. If a project has an internal rate of return greater than the required rate of return, it should be accepted. If not, then the project will be rejected. Those are the benefits of internal rate of return. Now the next slide. The drawbacks of internal rate of return. It can be difficult to calculate the internal rate of return, be precise about it, or explain its calculation to non-accountants. The internal rate of return does not provide results as an absolute value, but as a percentage. And that is the last slide in the end of this presentation. Before I close this video off, I am going to check the accessibilities and check each slides. Okay, just 1 hour, that's it. Duplicate slide title. Don't really need to. Let's go ahead and let's check the slides. No issues. No issues. No issues. No issues so far. No issues. No issues. No issues. Okay, that's now the end of the presentation. All slides are successfully checked. Accessibilities and spellings are correctly checked. So, this is going to be my last presentation of the night. So, I want to wish you all of you the best of luck in the future and say good night to all of you. Enjoy, have a good sleep. I hope you all have a great night. So, thank you all for watching this, and I'll see you all very soon, and enjoy your night. Adios.